Hello, everybody. So today I want to talk about super gems. So super gems is one of my three main style of investing. Super gem is I focus on companies that grow really, really fast, whose growth is very cheap, and who exceed a rule of 40. And this is a list. I have more than 150 stocks that I input in my spreadsheet. My spreadsheet is on Patreon. And based on that spreadsheet, I try to spot the most undervalued company that also grows very fast and also has that profitability above a rule of 40, which is what VCs look for. And VCs, of course, they have achieved one of the highest asset class before we saw this alien that is Bitcoin, right? Before Bitcoin, VCs were a thing. Now we have Bitcoin too, but I'm not an all-in type of investor, although I'm heavily concentrated. You know from my portfolio, if you've seen my prior video, that my two big buckets, 30% each, my two big buckets are, well, mostly the disruptors in the form of mostly Tesla and MicroStrategy, Bitcoin, some miners, and I regret to say that now MicroStrategy is much bigger than Bitcoin for me. So I have three general strategies. So hopefully that kind of helps you understand, like situate the channel where the channel is. I don't only do undervalued stocks. I don't only do super disruptive companies that seem obvious to me. I also do shorting the US dollar, the bond alternative, actually buying money, right? But not money in the form of a contract on a melting ice cube, which is the US dollar, but money in the form of either Bitcoin, a money that is scheduled to be deflationary relative to the USD, or in the form of a derivative of Bitcoin. And the derivative of Bitcoin would be, for me, my big one would be MicroStrategy, but CleanSpark, Iron, mining companies are also riskier derivatives of Bitcoin, but they are nonetheless derivatives of Bitcoin. So these prices will be a multiple of Bitcoin, right? And the prices of my super gem and the prices of my business disruptors, they will be a multiple of the dollar. And of course, when you're a multiple of the dollar, that means, in my view of the world is will be diluted. My view of the world, remember, this was one of my first video on the channel 2 years ago. My view of the world is we're going to be diluted at 15% a year. We're going to print dollars at 15% a year. To justify owning any company with a lot of business risk, in my view, one needs to have disruptive growth, disruptive innovation, companies that sell products that follow this S curve. And this S curve is kind of my style of investing. I try to go in a stock when their product shows early signs of adoption, and I try to get out of that stock when the product shows signs of adoption is done. And if you don't have another S curve beginning into a new product, then I want to be out of the stock. I want to ride the adoption curve for my business disruptors. And so these are stocks that someday I may be inclined, or for selling, I may be inclined to sell them someday. Same for my super gems. Someday I may be inclined to sell them, provided that they stop engaging in new S curves. For example, Tesla. If Tesla reaches 25% market share of all of the cars sold in the world, I better see a new S curve in the form, for example, of energy, in the form, for example, of whatever new product they have. If I don't see a new S curve, I see them, being a monopoly. Now they're kind of sleepy. Now they're kind of flat, right? They're kind of like the Apple. If Tesla becomes kind of like an Apple, then I'd be interested in exiting. I want to see the companies not only ride their main adoption curve, but they gotta come up with another way to grow, another way to reach that adoption curve. And so business disruptors, one of my main style of investing, includes Tesla, because I see it obvious as if we go electric, and by the way, 2035, gas cars are still banned in 2035 in most places of the world, despite all of the chatter we've heard about the past 2 years regarding electric cars not being a thing. These bans are still in place. So as far as I'm concerned, They're going to kill the ICE business just like they killed in 97 the tobacco business with a master settlement. That's as far as I'm concerned. And so I don't see anybody getting even close to that monopoly. So that's obvious to me, right? If you look at my plays, like, for example, SoFi or Nubank in Latin America, I ask myself quite simply, do we need tens of thousands of bank branches with millions of employees in a world where money is on an app? Do we need that? And the answer to me is obviously no. So I see adoption, I see major adoption on these phone apps, these financial apps. Same for HIMS. HIMS is a pharmacy stock. Do we need in the US 45,000 pharmacies? Same for Robinhood. Robinhood, it's got the best UI, the best UX. I mean, as far as trading interfaces go, it's not even in the same playing field in the financial world and in the asset management world. They are in the stratosphere. They're in an entirely different category. Do I see them getting adopted wildly by the next generation of investor, right? Do I see the next generation of investor when they inherit from their soon to be perhaps elderly parent, when they inherit that money, right? Where the money is going to go? Where is that going to shift? I think it's going to shift to the generational platform, the kind of a TD Ameritrade of Gen and Gen Alpha and Gen Z. That's the Robinhood. That's why I see these as the disruptors, the obvious, the product adoption. Shorting the USD, that's always been my bond alternative, and that's why it deserves a big chunk, right? Remove your age from 100, and typically it tells you how much you should be in stocks versus bonds. And so, yeah, I'm about 30, a little more than 30% now in shorting USD type assets, and that's absolutely, I think, the core of the channel. That's why I named this channel Beat the Denominator. And then I have my super gems. I have my super gems, which are the stocks that I want to buy when they look very, very cheap. And today, this video, as you saw in the thumbnail, today I want to talk about super gems. So it's an update. You'll see the stocks haven't changed much, but I'll just tell you my thoughts about each of these stocks and why they are a super gem. And as a reminder, these are hand selected from my spreadsheet. I just added 2 more stocks to the spreadsheet earlier this morning. Still can't find better than those. I mean, as far as the numbers go, but of course the numbers do not prevent anybody from doing qualitative analysis. Like, there's plenty of stocks in there that I don't own, right? Qualitative analysis is important, and we'll discuss SMCI in a second, right? SMCI, we'll discuss it in a second. You'll see, qualitative analysis first and foremost precedes any form of number. So let's go over my spreadsheet. My spreadsheet is important in many ways. There's important points on this. The first one is enterprise value over gross profit over revenue growth. I ask the question, how much am I paying for that product adoption? How much am I paying for that revenue growth? What's the cost of each percentage point of adoption forward on a forward basis, on the next 12 months basis? How much am I paying for each percentage point? And because this is the value-oriented part of my investing game, because this is value oriented, I select stocks not based on what I think they're going to do in the next 10 years, but based on how much am I paying for that growth that I'm getting today. I mean, in the next 12 months that I'm getting, pretty much the imminent growth that's coming up. How much am I paying for it? So when I look at HIMS is still, the absolute winner of all of these super gems at a 0.08. I pay that growth very cheaply, but I have another rule on this one, on this super gems. For it to be considered a gem, I don't want my companies to go bankrupt. I want them to have positive EBITDA margin. And I add the EBITDA margin to the growth. And that's when I get the VC's rule of 40 number. And of course, I'm looking to have that number exceeded. For a stock to get my consideration as a super gem, it needs to exceed the rule of 40, i.e., how much money they make, the proxy for cash flow, the EBITDA, and how much they're going to grow that product adoption, that pie, that revenue. When I add those two, I want to get more than 40. And this relates to the trade-off between making cash flow and growing, right? The more cash flow you make, technically, the less you grow, because that cash flow you're not using to invest in, say, marketing or invest in promotion, reducing the price of your product, etc. So HIMS to me is still the gem. And if you follow this channel, you know HIMS has been showing itself as the gem for more than a year and a half. Moving on to a stock that I haven't bought yet because there's so many deals right now is GigaCloud Technologies. I haven't bought it yet. GigaCloud is a drop shipping platform for big bulky items, and it allows a disruption of the furniture supply chain via a platform of sellers and drop shippers, manufacturers of furniture and drop shippers, people listing furniture or big bulky product on TikTok Shop, Amazon Marketplace, you name it, right? There's many drop shippers, there's many companies on the back end that handle that. GigaCloud is one of these companies in the back end. Of course, I would not be interested in this company if it wasn't showing such good numbers. This company is on there because it is showing excellent numbers. How much am I paying for that growth? It's very cheap. It's a 0.11, and the rule of 40 is 54. I have not pulled the trigger on GigaCloud, mostly because I don't like that it's up 130%. And that's psychological, and that's bias, right? It's like I don't pretend to not be biased. I have some biases myself too. Oddity, I have a small position in Oddity, right? Oddity is it's in the makeup business. So again, I'm going to be in that business because I find it cheap. Oddity is the makeup business. They have a brand called Il Maquillage that is very popular on social media, that grows fast on social media. And specifically, they make foundation, and they use AI to scan a woman's skin. They use Q&A to a few questions to select and design a foundation that is the exact color of the skin, which is a big problem in the makeup industry. And so they use AI, and so they're modern, and they scan you, and then you get a custom product. And once you get a custom product, in that case, a custom foundation, it's 1-to-1, right? It's a product, one person, one product. It's the exact color, and people get into it, and people get addicted because you're like, okay, well, this is my custom product. Kind of like what HIMS is doing with custom medication. You can get a custom makeup. Anyways, I'm interested in this company. Why? Because it's inexpensive. It grows fast, predicted to grow at 33%. The gross margin is 72%. The EBITDA margin is stunning to me at 22%, right? EV, enterprise value to forward sales is a 2.5, right? So these no way any of these stocks are expensive. They are cheap, but they are still growing, and they're achieving a rule of 40 out of 55, so quite special. And the 0.14 is their EV over GP over RG, so they are doing well. Now, talking about the elephant in the room, the stock that got cheap. So I bought a little bit of this stock. My position right now is like a 0.37 or 38. I recalculated it this morning after a drop. So let's call it 0.4% of my portfolio. So if it disappears, I don't really care. It'd be actually very interesting to see if I did better than the S&P 500, because anybody holding the S&P 500 actually holds SMCI, and SMCI was entered into the S&P 500 at its very peak. And it replaced Whirlpool, old world company, but Whirlpool, the company it replaced, stayed flat. And they replaced Whirlpool by SMCI and the S&P 500, and SMCI since then has lost 75% of its value. So, in that case, indexing doesn't really work too well if the committee selecting the stocks to join the index makes a mistake, right? And I'm not blaming them, because I could have made a mistake. So, like I said, my cost basis is under $40 for this stock. So I'm down, 30-ish%. Am I adding to it? It seems like I'm not. I keep going back and forth on this one. I might actually poll my community on Patreon to see what y'all think. I think of Luckin Coffee when I think about SMCI. Luckin Coffee, they're this company. They're still very attractive. They're still dirt cheap. And, they had also an accounting issue. And they didn't go out of business, but they stayed, kind of flat, kind of low for a very long time. So even though I'm interested mostly in top line, and when I see, of course, like what excites me about SMCI is the top line. I'm excited by the top line. I'm a top line investor. Revenue growth is outstanding for SMCI. They have the product that is needed for liquid cooling for NVIDIA's Blackwell. Love the top line. But I'm also mindful that other investors care about things like EPS, like profits. They're not a product adoption investor. I am a product adoption investor, but a lot of people care about these other things. And of course, when you have these auditor resignation issues, it doesn't send a lot of confidence about whether the EBITDA profitability is actually 9%, or is it more, or is it less. And of course, for people who actually use PE ratios and look at GAAP profitability, they're like, oh, wow, we're going to have to restate the earnings. The earnings may be 20% less than what they should have been. This company can't be trusted. So I'm aware that it's also the issue of you're not the only one buying the stock. So like I said, 0.37% of the portfolio. I think it's going to stay that way. I'm not adding to it, but I'm also not selling it. We'll see where it goes, because the top line on this company is great. And yeah. Anyways, moving on. Moving on to Transmedics. Transmedics is a company that I think the market overreacted selling off this one. I've been adding to this one lately. Transmedics, of course, is the organ care system company, the only FDA approved organ maintenance company. And what happens is you have somebody who unfortunately passes away because of traumatic injury of one sort or another, and they have said, perhaps on their ID, on their state driver license, they have said, hey, I'm an organ donor. And so what happens when that happens? Well, you typically have a surgeon who comes and collects the organs for the donation. And these organs, historically, they've been put into dry ice. This company has a product called the organ care system, where the organ is placed into an organ maintenance machine where the organ can live much longer. And the company is still predicted to grow like a weed, but it had a bump in the road because transplants were down in the U.S. This summer season. The number of organ transplants were down in the U.S. this summer season. We don't really know why. Everybody has its own theory. My own theory is that there's been a lot of bad trends on social media, where a lot of people may be opting out from becoming organ donors because of some of the stuff that has been trending. That's my theory, right? Other people have other theories saying that, say, hospitals are actually liking the inexpensive dry ice and sticking to the inexpensive way to do it, and they don't want to pay hundreds of thousands of dollars for an organ transplant. There's people that say that the business is down because Transmedics doesn't know how to operate an airline, and operating an airline is tough. And yes, that's true, but they also don't run planes that are worth $150 million like United or like Delta. They don't run passenger planes. They run planes that transport medical materials and very expensive materials. So anyways, some people are saying, oh, they shouldn't have done the airline. Some people are even saying they could just use a truck, not a truck, but you could just transport it by the road. You could transport it with an ambulance, and you could have an ambulance drive 10 hours overnight, and then the organ could be maintained alive, right? And you could have a team of 2 drivers, for example, a team of 2 drivers just driving an ambulance with the organ care system in the back, and you can potentially cover a lot of areas doing it that way and maybe not need an airplane. So anyways, doesn't change my thesis. I've been adding to this one. I think one quarter is not enough for me to say that the thesis is broken. You need multiple quarters of declining revenues in order to say that, and I don't think that's the case for them. So I'm happy to be buying this one. A stock that I've been also added it a while back, and I'm adding a little more to it. It's Genmab. So Genmab is an antibody company. They praise them. They pride themselves on being the specialist in the antibody business, and they use antibodies for cancer. So antibodies for cancer, it's one of these more novel treatment approaches to cancer. Their mission is to turn cancer into a chronic disease. And so what they do, it's a treatment. You get the antibodies, you get an injection or an IV of antibodies. It lasts hours. And those antibodies, through different mechanisms, they will go stick onto the cancer cells. And depending on how they work, they either increase the efficacy of a chemo treatment or of a chemo delivery system. And perhaps more exciting from my study of this company, they can trigger cell suicide. So it's called autoptosis, I believe, where you can trigger the cell into committing suicide. And so the antibodies connect the right way on the cancer cell. They stick to the cancer cell, and they trigger the suicide of the cell. Absolutely fascinating stuff. I love how they specialize on this. We talk a lot about genetics. Genetics gets the lion's share to say, oh, this is going to be the next big thing in medicine. Genetics, we move from traditional pharma to biotech to now DNA genetics, DNA, RNA editing, DNA editing. We have these companies like CRISPR that get the lion's share of the media, but I think this company, I think antibody medicine could be a real cure for a lot of big diseases, and it doesn't get any mind share, if I will say. Another company, which unfortunately is not as cheap, but another company that I cover on this channel is Lantheus. Lantheus is the use of radioactive isotopes to treat all sorts of different diseases, cancers as well, and to treat cancers with radioactivity through isotopes. Another fascinating business and fascinating type of drugs, which again doesn't get the lion's share of the discussion, because the lion's share of the discussion right now is on genetics and on GLP-1, and GLP-1s are actually fairly old. So anyways, company mostly makes money through royalties right now, and that's how it's done in pharmas. And because of that, because they co-commercialize a lot of your treatments, they get the royalties, and that's how you get to show that gross margin at 97%. They're predicted to grow 28%. The EBITDA margin is 34%. So you're getting into some beautiful EBITDA margin for companies that grow at 28%. Think about that. How much am I paying for that growth? It's a 0.17. It's cheap. And the rule of 40, you're 50% above the rule of 40 at a 62. And remember, I didn't say that, but Transmedics had a rule of 40 of 96. So that kind of makes me dream when I see that, right? A rule of 40 of 96 near 100. What? It's crazy. Okay, let's talk about Tidewater. Tidewater is a stock that I haven't covered yet for the channel, but I really should, because the performance is 52-week performance is down 12%. So to me, it looks like a decent price right now. It's still predicted to grow at 36%. Gross margin is 47%. And how much am I paying for the growth? I'm paying a 0.168, and the rule of 40 is a 69. I'm sure. That's an excellent rule of 40, of course. So when I see that rule of 40, when I see the EV over GP over RG, I also want to say another thing about Tidewater, what I like, which is a macro play. Tidewater is a macro play. What do? They're a vessel oil servicing oil company. So they service offshore rigs. They service a lot of operations in the oil industry for offshore type oil exploitation. They don't do the oil, they do the ships. They rent those ships. And why is that a macro play? Because there's a shortage of those ships. With the green movement the past 10 years, very few people have bought new ships. Very few companies have purchased these ships. And so the value of these vessels has gone up. And it could be a macro play if oil is one of these commodities that appreciates in the face of the decline of the dollar. And so I haven't jumped on this one. I don't own this one yet, because there's only so many stocks someone can have in a portfolio. But I'm monitoring it, and I still have to cover it to the channel and do my full due diligence to decide whether I'm interested in that or not. There's just so many opportunities right now, and I'm actively trying to eliminate a few stocks so that I can add new stocks, eliminate stocks that have been quote unquote dead money over the past 2 to 3 years. And so that's what I'm working on right now. So I might be adding some of these companies, including Tidewater, but I need to cover it for the channel. Another stock that, again, I am in mostly because it is cheap. This is not a sector I'm actively choosing, but it's ELF, E-L-F, ELF. So ELF stands for Eyes, Lips, Face. It's the makeup company of Generation Alpha, Generation Z, younger millennials. They pride themselves as being a prestige brand for the cost of a Target, essentially, like prestige brands at Target. So grocery store type price for makeup, but prestige type quality. That's what they attempt to be, and a lot of people are pleased with this product. It is one of the most popular cosmetics brand among the younger generation, makeup brand specifically, and it is inexpensive, and it's been down quite a bit. It was trading near 200 not too long ago. It's been down quite a bit, but doesn't really matter. I just look at my numbers. When I look at my numbers, it's predicted to grow its sales at 39%. The gross margin is expanded to 71%, and the EBITDA margin is 15%. So when I ask the question, how much am I paying for that growth? It's a 0.19. When I ask for a rule of 40, it's a 54. I do believe this is a quality company with a quality management, with a product. Of course, since I bought this stock, now I go out of my way to try to see it and notice it. And in my daily life out here in Texas, I see this product in the stores, all sorts of different stores. I go out of my way and I try to go into the cosmetics aisle, and I'm like, okay, well, yeah, I guess ELF is pretty big, and I guess they're working out, and they're also selling online, which is a big thing that a lot of old world company in the cosmetics world can't do. That ELF does is they sell a lot offline, direct to consumer. So it's a direct to consumer play. Many of these are somewhat direct to consumer play, right? Hims is also a direct to consumer play. Let me finish with Celsius. So I've been adding to this stock consistently. I'm so happy to see it in the $29 range now. So Celsius, it's vitamins in a can, is how I described it in my last Celsius video, and I think it's the best way to describe it. It's vitamins in a can. It was founded by I think he's Swedish. I'm not sure. It was founded by a fitness enthusiast and his wife. They were in the pre-workout business, and they got an early investor in the form of vitamins billionaire and Li Ka-shing, believe it or not. One of the most praised Chinese businessmen. Anyways, I guess he must have liked the drink. But the point is, this company, in my view, is taking a trajectory similar to that of Monster maybe 10 or 15 years ago. Their drink is everywhere in the US, and it is selling. And a lot of people is buying the drink. And it's all about perceptions. I know, a lot of people debate what is healthy. What is an healthy drink? What is not an healthy drink? I never claim this drink to be healthy or unhealthy. I'm just talking about the perception, and the perception of a buyer when they look at the nutrition facts, when they look at how the company is promoted. For example, Celsius is always promoted in the context of somebody working out or somebody at the gym. Kind of a novel approach compared to both Monster and Red Bull, which are promoted in the context of extreme sports, right? One of them is promoted in the context of extreme sports. Another one is promoted in the context of the gym, and also the promotion of Celsius. If you look, it features both men and women. So they are kind of going after the woman demographic, which I mean, when I see the Monster marketing, I can't say that the marketing of Monster is targeted at women. Then again, I don't know, but it doesn't seem as gender neutral as Celsius seems to me. And of course, when it comes to a drink, I would want it to be as popular among 100% of the population and not 50% of the population, right? The TAM is much bigger if you sell to both genders. So that's what they're doing. They got a lot of celebrities, very popular on Instagram, very popular among Gen Z, Gen Alpha, Gen. Well, I don't know about Gen, but at least Gen Z. At least let's say from the moment you start having caffeine, I see a lot of teenagers, at the gas stations, at Buc-ee's out here in Texas is where I see it the most. And it's just like, oh, okay, I will just grab 5 of them, and they're at the register, and they drop $12 on cans of Celsius. Anyways, it's a coffee alternative too, and a lot of people like it over coffee. It's one of these things. You may not see that in Europe. If you're in Europe, you may not see it. But who knows? Maybe they will flop in Europe and it will not be a thing, or maybe it will be a thing anyways. I think the price is compelling. How much am I paying for that growth? A 0.2. That's how much I'm paying for the growth. It's predicted to grow at 39%. Now, we can debate whether it's going to be 39% or not. Maybe it's a little less. If it's a little less, then what? You're going to be at a 0.3. Okay, well, it wouldn't be in my super gem spreadsheet, but it definitely would not be expensive either. So it's all about that debate. And the rule of 40 is 62 here. So again, profitable company, profitable business. Most of these stocks I've done deep dives on. So if you're interested in my more detailed thoughts about any of these companies, please go on the channel and look at the old videos. And as always, this was not financial advice, not investment advice ever on this channel, just entertainment. Hoping you were entertained. Please like, please subscribe. Thank you for watching. Follow me on Patreon, on X. Have a wonderful day.